Well, joining me now with more is Ben Emons. He's a founder of FedWatch Advisors. Ben, it's great to have you on the show this morning. And as I mentioned, a much better than expected jobs report. What does this mean?
Yeah, good morning, Kristen. It's a good number, and I was surprised myself. I do estimates on it and run a little model, and it really pointed in my model to an upside surprise. But this is even bigger, and it does underscore though that there's just a lot of people coming back into the labor force, finding work, and although the median duration of employment has increased, it does seem to be real demand in the leisure, hospitality, and construction and government sectors, even healthcare as well. So it just shows an underlying strength in the economy that continues and doesn't get weakened by higher rates or weakened by uncertainty geopolitically or anything like that. So I think it's about an economy that has already taken off while the Trump administration is just to start. So we can expect more of the strength to continue from here, which also means likely that treasury yields are going to go a bit higher from here too.
Interesting. So for 2024, with this final December jobs report, Ben, 2.2 million jobs added last year, down from 3 million in 2023, 4.5 million in 2022, and 6.4 million in 2021. Again, a lot of that boom in 2021 in the wake of those pandemic layoffs. You mentioned earlier you expect the momentum to continue into next year. Are we looking at gains of 200,000 plus for job additions each month?
So that will be amazing if that happens, because as you indicated, the strength has been slowing because of the effect of the reopening of the economy was so enormous that the people coming back into the labor force was very large at start and then starts to slow over time. And so it's interesting to make this point to say that this year could shift it, right? Meaning we're going to go higher with the payroll growth trend again because we're creating more jobs as we start to further increase economic activity domestically with the incentives that the Trump administration is planning to give the economy. Lower tax cuts, lower taxes for corporates, and more incentives to invest here. And then as a result, you're getting more jobs. So I would make the call at least that we're going to see some further strength in this first quarter, and that's against the original consensus. But further out is to be seen. We'll have to see how the tariffs impact the economy, how uncertainty further plays out. But it does look like a robust picture. So it's definitely not a situation where we slide off into any kind of recession at all this year. Rather, payroll growth will stay healthy and robust.
I think that's good news because we could see some volatility, as we normally do, around interest rates when it comes to the stock market, Ben. But your note there that you do not anticipate a recession should bode well long term for the markets based on experts that we've spoken to over time. But I do want to get your take on rates because many investors have been watching the path forward for borrowing costs or interest rates based on the Fed's move, which of course is a dual input of jobs and inflation. Do you anticipate that we get rate cuts in 2025?
Well, if you listen to Michelle Bowman yesterday, who is actually the most hawkish on the FOMC, right? Someone who's more prone about inflation and keeping that under control, then December was the last rate cut that we have seen for the time being. And it seems that some other FOMC members are coalescing around that view. And so it's not impossible to see no rate cuts, at least for the first half of this year. We can't think about the second half because there's just too much uncertainty about what happens then. But the fact that this economy is actually above trend and that the Fed policy is now closer, what they say, to the neutral rate, to neutral, means that there's actually not much room to cut at all. And if you look at this payroll growth number, and you're looking at the wage numbers, and you can apply some productivity from that, productivity is actually picking up. So that too indicates that the neutral rate is probably moving a little bit higher even from here, giving the Fed even less room to cut rates. So I think on all of that basis, the Fed has to stay on hold here, basically being in some sort of a quote-unquote lame duck position, if you will, right? It can't really raise rates, but it can certainly not cut rates at all. So it's likely to stay on hold for the time being.
We had heard Fed Chair Powell at that final December meeting forecast inflation of 2.5% this year, down from 2.8% last year. Based on this new input of data, does that change your expectation for inflation in 2025?
Well, the Fed was aggressive in its forecast, I felt, but core PCE, upgraded by 0.4% for this year. That's the largest single increase you've seen over the last 10 years. So that may materialize, because we do have a lot of like forces that are developing for inflation, not to mention this payroll growth, but also what we're seeing playing out in the energy markets. Plus, if you do going to boost the economy with more investment, you're going to, by definition, getting a hotter economy, an economy that could grow at full 5% range. That just implies an inflation rate that's not at 2%, but likely more at 3% or higher. So it is likely that we're going to see more inflation this year. And that would be leading to this Fed being very on guard, as in it may not hike immediately, but it would be very cautious about moving with policy and signaling that they're ready to move if inflation does go up even further. So expect a higher inflation environment, which also then reflected in that volatility, as you mentioned. The VIX is now above the average from the first Trump administration, the first year. I think that's notable too. Markets are gearing up for more volatile years as inflation picks up.
Ben Emons, founder of FedWatch Advisors. Ben, thanks so much for coming on, especially on a day when rates are in focus.
Thank you for having me. Thank you.